$43.73. That's where Enphase Energy, ticker ENPH, closed yesterday, May 7th, 2025. Now, this is a company, widely seen as a front runner in the solar energy market, which is just booming.
Absolutely, a big name.
So the big question we're tackling today is, with the stock right here, is this a dip you should maybe consider buying? Or is it a sign of deeper trouble for them?
That really is the core question, isn't it? We're diving deep into Enphase Energy today. Global player, known for their microinverter tech for solar and energy storage, too.
Right. It's a really fascinating company in a sector that's, well, critical.
Definitely.
And to help you get to the bottom of that question, we've really dug into the research. We've got a whole stack of stuff, including a brand new value investing analysis, like hot off the press as of today, May 8th, 2025.
Yeah, our goal here is simple, really. We want to cut through all the market noise, the day-to-day chatter, and figure out what's really driving Enphase right now.
Understand their long-term potential, basically,
Yeah.
and help you weigh the opportunity versus, the risks involved at this particular moment.
Exactly.
Okay, so here's how we'll break it down for you. We're going to start with the basics. What does Enphase actually do? How do they make money?
The fundamentals.
Then we'll look at the leadership team, who's running the show,
Crucial.
and of course we have to dive into the numbers, the financial health check.
Can't skip that.
Yeah.
Then, in the second half, we'll shift gears a bit. Look at market sentiment. What does Wall Street think?
And who owns the stock? Who are the big players?
Right. And we'll really unpack the big challenges and opportunities ahead. That definitely includes a close look at those new U.S. tariffs everyone's talking about.
Definitely. And stick around to the end, because we've got a key takeaway, maybe something a little surprising.
Yeah, a perspective you might not expect.
All right, so if this kind of deep dive sounds useful, hit that subscribe button so you don't miss our next ones. Ready to jump in.
Let's do it. Chapter 1, Business Understanding. So, what's the core of Enphase?
At its heart, Enphase provides these integrated home energy solutions. Very software-driven. They were the pioneers, really, and still lead in microinverter technology.
Okay, microinverters. Remind us, how are they different from, the traditional setup?
So instead of one big central inverter for all your solar panels, Enphase puts a small microinverter on each panel. It converts the DC power to AC right there at the module level.
Gotcha. And why is that better? What are the advantages?
Well, there are several key ones. First, you get more energy. Since each panel works independently, shade or a problem with one panel doesn't drag down the whole system.
Ah, okay. So better performance overall.
Exactly. Second, reliability. If one microinverter fails, the rest keep working. Not like a central inverter failure, which shuts everything down.
Right, that's a big selling point.
Third, safety. You have lower AC voltage on the roof, not high voltage DC like with string inverters. Plus, it offers more flexibility in designing the system, you can scale it easily, and homeowners get to see how each individual panel is doing through the Enphase app.
That module-level monitoring sounds pretty useful for homeowners.
Definitely. And they keep innovating, right? What's the latest tech?
Yeah, they don't stand still. The current main product is the IQ8 series. They even have high-power versions, the IQ8P and HC, for those newer, more powerful solar panels.
Okay.
And looking ahead, they're working on the IQ9 series that's expected to use gallium nitride, or GaN, technology.
Oh, JN, right. That's supposed to be more efficient, smaller?
Exactly. Potentially higher efficiency in a smaller package. That's the goal.
No, it's not just microinverters anymore, is it? They've built this whole ecosystem.
Oh, absolutely. And that ecosystem is really central to their strategy. It's not just the IQ microinverters, it's IQ batteries too.
Right, the storage piece.
Yeah, using LFP chemistry, lithium iron phosphate, known for being stable, lasting longer. They come in different sizes, you can add more later, and crucially, they give you backup power.
Okay. What else is in there?
IQ EV chargers, smart ones that tie into the whole system. Then you got the IQ Gateway and Combiner, that's the communication hub. Energy management tools like the IQ Energy Router load controller. It gets pretty sophisticated.
Wow.
And tools for the users and installers too. The Enphase app, Enlighten Manager portal, even design software called Solar Graph. Oh, and a portable power station, the IQ Power Pack.
So why build all that? What's the strategic thinking?
It's all about increasing customer stickiness. If you're already using their app for solar, you're probably more likely to get their battery or EV charger for that smooth, integrated experience.
Makes sense. Keeps people in their world.
Exactly. And it builds loyalty with installers, too, because they invest time learning the platform. Plus, it gives Enphase multiple ways to make money, not just the hardware, but software upgrades, service fees.
Right. Recurring revenue potential.
and it just makes the whole package more valuable, harder for competitors to displace. Creates barriers to switching.
Okay, so let's talk revenue streams then. Where's the money coming from, primarily?
Primarily, yeah, it's hardware sales, microinverters, batteries, EV chargers, plus all the accessories that go with them.
Got it.
Then you have software and services revenue, things like premium monitoring plans, fees when a system changes ownership. And recently, safe harbor revenue has been noticeable.
Safe harbor, what's that?
That's basically when customers prepay for equipment, maybe to lock in a tax credit before it expires, even if the installation happens later. And looking forward, there's potential revenue from grid services, like using aggregated home batteries and virtual power plants to help the grid. That's still developing, though.
Interesting. Okay, what about making all this stuff? How do they handle manufacturing?
They use what's called an asset-light model. So they don't own the factories themselves. They contract with third-party manufacturers, big names like Flex, Salcomp, Sunwoda.
So they outsource the actual production.
Right. It gives them flexibility, scalability, less capital tied up in plants. But there's been a really big strategic shift lately.
Oh, yeah. What's that?
Moving manufacturing to the United States. They've ramped up facilities in South Carolina and Texas, first microinverters, and now batteries too.
Wow, that is a big shift. Why do that? Seems expensive.
Several reasons. One is supply chain resilience, reducing dependence on overseas production after all the recent disruptions.
Makes sense.
But maybe even bigger is the Inflation Reduction Act, the IRA. Huge incentives like the 45X manufacturing tax credit for making stuff domestically.
Right, the government incentives.
Exactly.
Yeah.
And it can help their customers, too, potentially qualifying them for bonus tax credits if they use U.S.-made gear. As of Q1 this year, like 80% of their microinverters shipped were from those U.S. plants.
So it helps with tariffs, too, presumably. And margins?
Definitely. It's a hedge against certain import tariffs, and those IRA credits directly boost their profit margins. It's a major strategic play, potentially a huge long-term advantage.
Okay, that's a great overview of the business. Let's pivot to Chapter 2, management. Who's leading Enphase?
The main person is the president and CEO, Badri Kothandaraman. Usually just goes by Badri. He has a strong semiconductor background.
Oh, okay.
And he's really credited with turning the company around after 2017. Refocused on profit, launched the successful IQ series. His experience seems pretty relevant now with the market slowing down and these tariff issues.
Any recent signs from him?
Interestingly, yes. Back in April 2025, he bought about $185,000 worth of Enphase stock himself, an insider buy.
Oh, that's often seen as a sign of confidence, right?
He can be, yeah. Shows he believes in the company's future, potentially. Other key people include Mandy Yang, the CFO, Raghu Belur, co-founder and chief products officer, and Jess McNeil, the COO. Martin Fornage, another co-founder, is still involved too.
And what's their track record like overall? Do their actions match what they say?
Historically, strong on innovation. That's clear. Lately, their communication seems pretty open, especially about the market downturn and the tariff impacts. They've been quite upfront in earnings calls.
Transparency is good.
Yeah. Their stated values are things like customer focus, integrity, innovation. And you see actions aligning with that, like their focus on improving customer satisfaction scores, net promoter scores, or NPS.
Okay.
And obviously, the consistent R&D spending backs up the innovation claim. They also talk about ethical practices, human rights in their supply chain.
But there are those lawsuits hanging over them, aren't there? The class actions.
Yes, that's a significant issue, filed late 2024, early 2025. They allege misrepresentations and disclosures between April 23 and October 24, securities law violation.
Oof, what's the potential damage?
Plaintiffs are seeking damages. Estimates are maybe $750 million potential liability. It's definitely a risk, a distraction for management, and raises questions about their disclosures during that period.
So how does the CEO buying stock fit with that? Seems like a mixed signal.
It does. Maybe he thinks the suits lack merit or the impact is manageable. Hard to say for sure, but it's an interesting contrast.
Definitely. Okay, let's talk capital allocation. Where are they putting their money?
R&D is a big one, consistently, like 15–17% of revenue recently. That fuels the next-gen products, IQ9, IQ10, better batteries, EV chargers, software. It's crucial for staying ahead.
Makes sense for a tech leader. What else?
Share buybacks. They've been active, finished a $200 million program, then started a new $500 million one in July 23. They've used a good chunk of that already.
What's their thinking behind the buybacks?
They say it's opportunistic buying when they think the stock is undervalued. Also helps offset dilution from employee stock options. They clearly prefer buybacks over dividends right now.
Right, no dividends. What about M&A? acquisitions.
It seems to be part of the strategy, but targeted. They bought Greencom Networks and Solar Lead Factory back in 2022. Seems like they look for specific tech or capabilities to add to their ecosystem rather than huge deals.
Okay. And how are they managing debt?
As of end of Q1 25, about $1.23 billion in total debt,
Okay.
but they also had over $1.5 billion in cash and securities. So a good cash cushion.
Net cash positive then.
Pretty much, yeah. They actually paid off some convertible notes earlier this year. Their debt-to-equity ratio is around 1.6 based on last year, so it's something to keep an eye on. But the cash and positive free cash flow help a lot. Interest coverage looks comfortable, too.
And quickly, corporate governance. Anything stand out?
Standard practices mostly. They have a classified board directors serve staggered terms. Some argue that helps continuity, others worry about accountability.
Right, the usual debate.
Yeah. Executive pay is supposed to be tied to performance, pay for performance. They communicate through IR, earnings calls, ESG reports. Pretty standard stuff. Governance scores look decent, maybe room for improvement on the environmental side, according to some ratings.
Okay, solid overview of the management side. Let's get into the nitty-gritty. Chapter 3, financial health. This is where the rubber meets the road. What's the big picture financially?
It's really a tale of two periods. Explosive growth up until 2023 revenue went from like $774 million in 2020 to almost $2.3 billion in 2023.
Wow, huge growth.
Huge. But then 2024 saw a sharp reversal. Revenue dropped 42% to $1.33 billion.
Ouch. And that continued into this year.
Yeah, Q1 2025 revenue was down 7% from Q4 24. Now, it was up 35% compared to Q1 last year, but Q1 24 was already showing weakness.
So the year-over-year comparison is a bit misleading.
A little bit, yeah.
Yeah.
And their guidance for Q2 suggests things aren't really picking up much, yet flat to maybe a slight decline. It reflects that slowdown in U.S. residential solar and some earlier weakness in Europe, although Europe did see better battery sales in Q1.
Okay, revenue's under pressure. What about profits? Earnings?
Same story, really.
Sure.
GAAP EPS dropped significantly in 2024 compared to 23. And Q1 25 earnings actually missed analyst estimates, both GAAP and non-GAAP.
So analysts are probably lowering expectations for the rest of the year.
Exactly. The consensus forecast is for lower EPS again in 2025 compared to 2024.
Are they just selling fewer things? What do the shipment volumes look like?
Microinverter shipments definitely dropped from Q4 24 to Q1 25. Went from about 2 million down to 1.5 million.
Okay, that's a noticeable drop.
It is. Interestingly, battery shipments actually went up a bit in Q1, from about 152 milliwatters to 170 milliwatt.
Huh. So a bit of a mixed picture there.
Yeah, but the overall pattern, rapid growth and sharp contraction, really highlights how sensitive they are to market cycles and policy changes. That kind of volatility makes it tougher for, traditional value investors looking for predictability.
Right. Now, historically, Enphase had really strong profit margins. How are those holding up?
They have been strong, yeah. GAAP gross margin was actually up over 47% in 2024. Non-GAAP even higher, near 49%. And Q1 25 stayed pretty much at those levels.
That sounds impressive given the revenue drop. How?
Well, here's the key thing. The IRA manufacturing tax credits, they provided a huge boost, like 10.6 percentage points to non-GAAP gross margin in Q1.
Oh, so without the IRA credits, the underlying margin is much lower.
Considerably lower, yeah. Around 38.3% non-GAAP in Q1 if you strip out the IRA benefit. It shows how much those incentives are helping right now.
And you mentioned near-term pressure earlier, related to the tariffs.
Exactly. Their Q2 guidance points to lower gross margins. They specifically called out about a 2 percentage point negative hit just from the new tariffs starting to bite.
Okay, 2 points in Q2, but it gets worse.
That's what management is saying. They expect the total gross margin impact from tariffs to hit 6 to 8 percentage points starting in Q3 once they use up their pre-tariff battery inventory.
6 to 8%, that's huge, especially for batteries, a growth area.
It's a major concern. They basically said storage margins will be insignificant in the near term. It really tests their profitability and shows that reliance on the IRA credits to offset these kinds of headwinds.
What about operating margins? Taking a hit too.
Yes, similar story. Operating income and margins, both GAAP and non-GAAP, were down in Q1 compared to Q4. Lower revenue and gross margin flowing through, even though they did cut some operating expenses in Q1.
Okay, so profitability is under pressure. What about the balance sheet? Is it strong enough to weather this?
It looks pretty solid, actually. As of March 31st, they had $1.53 billion in cash and marketable securities. That's a lot of liquidity.
Definitely a good cushion.
Yeah. Current assets, well above current liabilities, healthy working capital. Accounts receivable and inventory are down from a year ago, which isn't necessarily bad in a slowing market. Debt is around $1.2 billion, but less than their cash. Debt to equity needs watching, but it's not alarming given the cash buffer. Current ratio looks fine.
So they have the financial strength to navigate this downturn.
It certainly appears so. The cash provides a significant buffer.
Okay, last financial point. Cash flow and return on invested capital, ROIC. How are they doing there?
Historically, strong free cash flow generators, partly thanks to that asset-light model. Trailing 12-month free cash flow was still pretty healthy at around $480 million as of Q1, a decent yield. They were free cash flow positive in Q1 too, despite lower earnings. So they still have flexibility.
I sense a but coming.
But the ROIC trend is a worry. It's way down from historical peaks. Recent numbers have been in the single digits, sometimes low single digits.
Lower than their cost of capital.
Yeah, their annualized Q1 ROIC was around 5.75%, and their estimated cost of capital, WACC, is over 10%. When your return is less than your cost of capital, that destroys value over time.
So turning that ROIC trend around is critical.
Absolutely critical for long-term value creation. Return on equity, ROE, is also down.
Okay, that gives us a really comprehensive picture of the financials. Lots to digest there.
Definitely.
All right, that wraps up the first half of our deep dive into Enphase Energy. We've covered the business, the management, the financials. When we come back, we'll dive into market sentiment, ownership, the SWOT analysis, and crucially, get deeper into those 2025 U.S. tariffs.
And don't forget that key takeaway at the end. Plus, for anyone wanting to check our work, all the sources we used are listed in the description.
Absolutely. If you're finding this useful, hit subscribe so you don't miss the second half or our future deep dives. We'll be right back. Brief pause.
Welcome back. We're continuing our deep dive into Enphase Energy. Before the break, we covered their business, management, and financials. Now, let's shift to Chapter 4. Market sentiment. What's the general vibe around Enphase in the market right now?
I'd say the vibe is cautious. Definitely some near-term concern, even if there's longer-term optimism mixed in.
How do you see that, like in analyst ratings?
Yeah, looking at analyst ratings, the average is kind of a hold or maybe moderate buy.
Yeah.
Around 37 analysts cover. The average price target is way above where the stock is trading now.
Okay, so that sounds bullish.
Well, yes and no. The range of those price targets is huge. Like from $33 all the way up to $125. That widespread just screams uncertainty about the near term.
Right. A lot of disagreement among analysts. Exactly. And we saw downgrades and target cuts after the last earnings report, the one that missed expectations. The consensus is definitely for lower earnings this year, and more analysts have turned negative recently. So near-term caution is the main theme.
Okay, cautious analysts. What about who actually owns the stock? Does that tell us anything?
Yeah, institutional ownership is really high, around 94%. Big funds like Vanguard, BlackRock, Bailey Gifford are major holders.
So the big money still believes, mostly.
It suggests strong conviction from professional investors, yeah.
Yeah?
But it also means if those big guys decide to sell, it can move the stock price a lot, volatility.
Right. What about insiders? Management owning stock.
Insider ownership is pretty low, actually, around 3.2%. We mentioned the CEO's recent buy, which is interesting.
The 185K buy.
Right. But there have been some sales by other execs, too, so bit of a mixed picture from insiders.
Got it. And one metric that often signals skepticism is short interest. How does Enphase look there?
It's high, really high. Around 18 or 19% of the float is short.
Wow, that's significant. So lots of people betting the price will go down.
Yeah, exactly. It reflects all the concerns we talked about. Valuation worries, the market slowdown, competition, especially from Tesla, and definitely the impact of these new tariffs.
Yeah, the stock hasn't done well compared to the market lately either.
It hasn't. That high short interest is a clear signal of bearish sentiment and perceived risk right now.
Okay, that leads us perfectly into Chapter 6, risk assessment. Let's do a quick SWOT analysis for them. Strengths, weaknesses, opportunities, threats. What are Enphase's core strengths?
Okay, strengths. Technology leadership and microinverters, definitely number one. That integrated ecosystem we talked about, big strength, strong brand and installer network, solid cash position on the balance sheet. That strategic move to U.S. manufacture and huge potential strength with the IRA benefits and tariff mitigation, and their patent portfolio protecting their tech.
Okay, good list of strengths. Now, the flip side, weaknesses. Where are they vulnerable?
The biggest immediate one is that tariff impact, especially on battery margins. That's a major weakness right now. Their reliance on the U.S. residential market makes them vulnerable to its cycles, like the current slowdown.
Right, competition.
Yep, increasing competition, Tesla being a key one. Some supply chain concentration risk with those contract manufacturers. The recent drop in revenue, earnings, ROIC, that's a clear financial weakness. And some installers still find their systems maybe a bit more complex to install.
Okay. Let's look ahead now. Opportunities. Where's the potential upside?
Huge opportunity in energy storage globally. International expansion is another big one. New products, IQ9, better batteries, EV chargers, software upgrades, grid services, VPPs, that's a potential future revenue stream. And just the whole electrification trend, right? EVs, home energy management, that's a massive long-term tailwind for what they do.
Absolutely. Okay, finally, threats. What are the big external risks they face?
Competition getting even tougher, maybe from low-cost Asian players too. Policy risk is huge changes to the IRA, net metering, future tariffs, macroeconomic stuff, interest rates, recession fears impacting demand.
Yeah, always a factor.
Technological disruption, someone coming up with a better, cheaper alternative, supply chain volatility from geopolitics. And that ongoing class action lawsuit is definitely a threat, both financially and reputationally.
Okay, that SWOT gives a really clear picture of the landscape. Now let's zero in on Chapter 7, the impact of those 2025 U.S. tariffs. This seems critical right now.
It really is. The trade situation got complicated fast. April 2025 brought these reciprocal tariffs 10% baseline, but way higher on specific countries like Vietnam, Thailand, Malaysia.
Right, some up near 50%.
Yeah. Potential July increases are paused for now, but the uncertainty is there.
Oh.
Plus, specific high tariffs on Chinese goods, potentially 34% or even 145% for some battery components. Add in older tariffs like Section 201. It's a mess.
So how does this tariff mess hit Enphase specifically? Does it affect everything?
Not equally. For microinverters and accessories, they think the impact will be minimal. That's thanks to the U.S. manufacturing shift and diversified sourcing for other parts.
Okay, so the U.S. plants are really helping there.
Absolutely. But the IQ batteries are getting hit hard.
Why them specifically?
Because they currently rely on battery cell packs coming from China.
Yeah.
And those are subject to the higher tariffs.
Ah, okay. So what's the damage estimate?
They've already guided for about a 2 percentage point hit to gross margin in Q2, just from this.
2 points.
But starting Q3, once the pre-tariff inventory runs out, they're projecting a total hit of 6 to 8 percentage points on gross margin.
6 to 8, that's what you mentioned earlier, makes storage margins insignificant.
Exactly. It's a huge blow to profitability in a key growth segment. It's driving that lower Q2 margin guidance.
So what are they doing about it? How do they fight back against an 8% margin hit on batteries?
Their main strategy is diversifying the battery supply chain fast, getting cell packs from outside China. They say they found tangible sourcing options.
Okay, so finding new suppliers, how long will that take?
They're aiming to fully offset the tariff impact by Q2 2026, so about a year from mid-2025.
A year of significantly lower battery margins then.
Seems likely. They're also trying some price adjustments, passing costs on, but that's already factored into this 6 to 8% hit estimate. And the U.S. microinverter manufacturing continues to be key for avoiding tariffs there.
So it really hinges on executing that battery supply chain shift over the next year. That sounds challenging.
It is. Qualifying new suppliers for cost, quality, scale, it's complex. And non-Chinese suppliers might just cost more anyway. That period from Q3 25 to mid-26 looks tough for battery profits. If they can't pull off this shift, it could really hurt that business long term.
Okay, that makes the tariff situation much clearer and its importance. That brings us towards the conclusion of our deep dive. We've certainly covered a ton.
We have. We've looked at a company, Enphase, with a strong core business, great tech, but facing real headwinds right now. Tariffs, competition, a slowing U.S. market.
Yeah, and the financials showed that pressure revenue earnings, that concerning ROIC trend. Market sentiment is cautious, short interest is high.
Exactly. A lot of challenges.
So after laying all that out, what's the surprising takeaway you mentioned at the start?
Okay, here it is. Despite all those headwinds, the tariffs, the slowdown, the surprising thing is that Enphase's big, aggressive bet on U.S. manufacturing, helped by the IRA, might actually be the key strategic advantage that lets them navigate this storm.
Interesting. So the thing causing some pain now, adjusting manufacturing, could be their long-term strength.
Potentially, yes.
Yeah.
By building domestic capacity, they could be much better positioned than competitors still reliant on overseas production to capitalize on the long-term growth of solar and storage here. It could make them more resilient.
The big if is executing that battery supply chain shift.
That's the critical piece to watch over the next year. Their ability to successfully diversify battery sourcing away from China without killing margins permanently will really determine if this U.S. manufacturing bet pays off in the way it potentially could. It's the linchpin right now.
That's a fascinating angle. The near-term pain potentially leading to long-term gain if they execute well really highlights the strategic importance of adapting to policy changes.
Exactly. It's a real-time case study in strategic response to the shifting landscape.
Well, this has been incredibly insightful. If you found this deep dive into Enphase Energy valuable, please do subscribe to the Stock Analytics AI YouTube channel. We do these deep dives regularly.
And just a reminder, this analysis is based on public information as of May 8th, 2025. It's not financial advice. Always do your own thorough research and understand the risks before making any investment decisions. We should also note that AI assisted in preparing the underlying research for today's discussion.
Absolutely. Thanks for joining us for this deep dive.